happened here? This is... All right, sorry, I don't know what happened right there. I think I had a bad connection for a second. For a second there. This is Alex Dumas, your financial literacy coach, and I'm really excited to give you this part 2 of how to double your income. Anybody who was on yesterday, you got a chance to view that, and I had an opportunity to share that. So I had some things I just wanted to wrap up, some things that I just wanted to explain in depth and a little bit further. I know it's Friday night. Everybody's out celebrating, probably getting ready for the big fight tomorrow night. So I wanted to make this really quick, really simple. So just to do a really quick recap, we talked about this thing yesterday, the rule of 72, right? So Einstein, that whole deal with doubling your income, right? So doubling the interest rate. So remember what I said, that anything that you divide 72 into, that's how long it takes for it to double. So if you take 1%, which is, more than what most traditional banks are giving you on your interest on your savings accounts, that means it's going to take 72 years for your money to double. That's pretty awesome, right? Not so much. So I gave an example of, what if you had 4%? Now that's going to cut your double down to 18 years. Nice quick turnaround, but as we go through the numbers, it's going to not be as great as we want it to be. And then there's 10%. And you're looking at about 7 years. So from 72 to 18 to 7. So what that means is, I used an example of someone having $10,000 in an account. Hi, Roselle, thank you for watching. Hi, babe. Hi, Sarah. $10,000 they're investing, right? They have saved into, a bucket here that has 1%. So that means in 72 years, if they're age 30 right now with that 10,000, by the time they're 102, that's when they're going to see their money first double, 20,000. Hope that makes sense. Pretty simple. 4%. Now with 18 years, take that same 10,000. You're age 30, so that means you're going to see your first double when you turn 48. So 20K. Pretty cool. Move on from there. You get to 66, and you actually are with 40,000, and we already know that being 65 and up, $40,000 is not really going to cut it as far as not outliving your money. And then we talked about 10%. So same 10,000 right here, you're age 30. By the time you're 37, get your first double, 20,000. Then to 40,000, age 44, 51, we have 80, 58. We got 160. Pretty cool. And then at 65, we're looking at 320. So not rocket science, but what would you rather be at, by the time you're 65? 320 or 40? Money, numbers don't lie. So that's just a quick recap of that. So I wanted to show you real quickly how that connects with something else I talked about before called my 2 circles. Hi, Tuan. Thank you for checking in. So there's a lot of recaps today, all right? So 2 circles right here. So this is a traditional bucket where most money is saved. This here is my secret circle. We'll talk about this in a little bit. So traditionally, there's 3 places that people save their money. We talked about the banks. Why? Because it's safe. Sorry for the board for shaking. It's safe. Most people, it's insured there. It's protected, which is fine. The challenge with that is that you have a low rate of return. So that previous example I said, where someone's going to earn 1%. Thank you. Nicely done. 1%, the banks are usually giving like 0.02, 0.03, something along those lines. So low rates of return, that means it's going to grow really fixed. I'm going to illustrate that really quickly for you. Next place, most people, some people put their money is they like to invest it. So stock markets, 401ks, 403bs. Positive of that, this is why I have a plus, is you get a high rate of return. You can make a lot of money in the stock market, no doubt about that. But we've seen in recent years that what comes up has to go down. So the negative with that is you have risk. some people's 401ks become 201ks. Some people, the whole retirement, their whole life savings wiped out, just like that in a matter of days, weeks, months. And imagine working 30, 20, 30, 40 years, getting ready to, finally ride up into the sunset, your golden years, and then all of a sudden it's gone. And now you're already at your foot out the door, metaphorically speaking, with your work, and now you have to kind of rebuild and start over. And unfortunately, that's where you see a lot of people at today, where they're going through situations where, you see, older folks still working like at Walmart. I'm not judging you, got to do what you have to do, but I'm sure that's not what they planned. That's not what they really envisioned in their 20s and their 30s, thinking, hey, I'm with my sweetheart. We're going to ride off, hang out with the grandkids, travel, do all these sorts of things. And instead they're asking you to have a nice day. They're bagging your groceries. So that's not really what they were looking for. And so the other thing I talked about was the tax-free option, or we call it 7702 plan. If you want, look it up, Google it. IRC code 7702. This is not something that I made up. This is not my plan that I created. This is from Uncle Sam himself. So what they did here was combine the best features of these two, the safety and the high rates of return. So hopefully you'll be able to see this. What's up, Joe? Good to see you. Actually, let me wipe this out real quick. Hang on for a second. Let's give you some of the rest of this board. So here we go. This is kind of what the stock market looks like, ups and downs. It's a big dramatic thing. Hi, Chris. Thank you for checking in. So let's think about this for a second. We have the safety here of the banks, because this red right here, they're going to give you a floor. Here, this plan gives you a floor of 0.75%. So even when the stock market, even when everything's tanking and going haywire, you're going zero, you're going into the negatives, all that kind of stuff, 0.75, you can never go below that. Now, what has a floor has to have a ceiling. So that ceiling or that cap is at 15%. So you might do 25, 20, 30. Hi, Marie. Thank you for checking in. All these high rates, but you cap off at 15%. Now, my firm here, we've been able to help out clients and get them, averaging. This is, just an average. This is just roughly, some have been higher, some have been lower, but 9.75% over the last, say 20, almost 25 years. This has been performing. What's up, Jared? Good to see you. So 9.75%. So let's just kind of take a look at what that looks like, right? So with the banks, you have the safety. So that means it grows on a fixed, oops, messing up my markers here, on a fixed rate. So while it's safe, like I said, low rate of return. So your money really doesn't grow. It's safe, but it's safely dying, if that makes sense. And you kind of think back what I said about that, the rule of 72, where that 1% is going to double in 72 years. This is the reason why, because it's the growth is so fixed. Now, you think about the stock market, it's up and down, it's a variable. So 1 month it might be great, or 1 year might be great, next year might not be so great. Ups and down, you can't predict it. It looks like a heart attack. If you look at it, it's, over here in the bank, you're flatlining, you're dead. Up in here, over here, it's like EKG, you're just up and down, up and down, up and down. So what this 7702 does is what we call an index. So you get to take advantage of the high earning potential here. You get to participate with the growth, but you never experience a loss, because the safety here, you're locked in at a certain rate. Like I said, doesn't go below 0.75. Once things start to perform, do better, you're going up. So it's like a staircase. Think of it like that. So hopefully that makes sense. And now the real point where I wanted to get to is here in this bucket. So sorry, I'm erasing everything for you guys, but you can rewatch the video. Anybody else is catching this on a replay, thank you for checking in too. So all these things, the tax-free option, the 7702, the reason why that works is because of this thing we call index universal life insurance. So let's just use, for example, this family here has a $500,000 policy, and there's ways that we can help them calculate, how much is, really necessary. Hi, Jackie, good to see you. What's up, Miss Porter? So the IUL here, right? Index Universal Life. So this has really cool components to it because there's 3 things that we know are going to happen in our lifetimes. Everybody here watching is going to die. Sorry to be the bearer of bad news. You're not going to get out of life alive. It's just how it works. That's the deal. So you go. The money that you have in here, with the policy also, it's a cash value accumulation. Goes to your family, everybody's happy, and that's on a tax-free basis. Government can't touch that. After tax dollars, of course, put into here, then the growth and the interest is tax-free. So 2, I know that I'm going to become disabled. At least there's a strong chance. There's about a 70% chance that either myself or you are going to become disabled. We're going to need long-term care at some point of our lifetimes. We're going to need somebody to wash us, to feed us, bathe us, dress us, your basic daily living activities. And 3, which I'm looking forward to, hopefully it happens, I'm looking forward to living a long time. So by me living a long time, now I get to actually draw money from the savings bucket here and use that as a supplemental retirement. If I'm, hurt and disabled, I can pull money from here tax-free too. So I don't have to sell my house, I don't have to sell cars, I don't have to, wipe out most of my assets just to qualify for some government assistance, if that makes sense. Or, have friends and family help me out. So this is a really awesome and powerful tool right here that, unfortunately, very few people have been privileged to get that. Mark, what's going on? Good to see you. Erica, how you doing? Hope you're safe in Florida and hurricane didn't wipe you out too bad. But these 3 buckets here, these 3 things are going to happen to everybody eventually. So why not have something in place that you have access to your money tax-free? Why not have something that you have the protection knowing that, you never heard of an insurance company going bankrupt before, right? There's no bailouts for them. I don't want to knock anything to banks or, stocks because honestly, you need all 3. You need all 3 buckets. You need all 3 savings plans. You need to have your liquid cash. It's nice to have some investment money, but it's also good to have a good chunk of this saved here because it's protected already. You already know that it's going to grow. You already know that it's not going to lose its value. So I just wanted to share that with you guys. Hope that was really clear. If you have any questions, feel free to shoot me a message, enter in the comments, private message me if you want. If you have my phone number, feel free to give me a call or shoot me a text. If you think somebody out there could benefit from, this message and, just a conversation, feel free to, let me know or let them know they can contact me. I'm an open book. I'm always here to help. Marco, good to see you. Sorry you checked in a little late, but catch the replay. But that's my time for tonight. I'm going to take the night off tomorrow because I'm going to be watching the fight. I'm a big fight fan. I got to love go with Triple G for that one. But other than that, hope you all have a safe Friday night. Thank you for checking in once again, and till next time.